comments that I would like to make everybody aware of. Prior to 2020 and prior to the pandemic, one of the big efforts that we had was in education. And we used to host educational forums at least once a quarter, and not uncommonly, we would be hosting some sort of educational forum on even a monthly basis. Obviously, when the pandemic hit last year, all of that had to get squashed, and we've been working hard on bringing some more virtual ways where we can stay connected, continue to educate you and the people that you care about. And I'm excited, and some of you have probably read some of the announcements that we put out about our educational series that we've launched. And I just want to bring a couple things to your attention. And actually, before I get into the education part, I do want to touch on our charitable cause for the first quarter of 2021. A lot of you on this call have been clients for many, many years, some decades, some multiple decades. And one of the things that we've always felt very strongly about as an organization is our commitment and really our duty to give back to our community. The vast majority of you, and obviously we live here in Arizona, we do have clients that are kind of all over the country. It's kind of fun as I'm seeing you log on here. You're in different places over in Albuquerque and different places throughout the country. But we've made it a purpose in our business to focus on giving back to the community. We even decided about 6 years ago to develop something a little bit more formal of what we now call Wild for Arizona, which is intentionally our community outreach program. And we organize under that name in all of our community efforts. We had a tremendous fundraise in the fourth quarter with our annual Toys for Tots toy drive. So thank you all who helped be a part of that. We had just over 300 new unwrapped toys that we donated, and it was close to $5,000 in cash donations between your donations and the dollars that we matched. So thank you for that participation. For the first quarter of 2020, we've chosen a local organization, and I'm going to cheat a little bit here off my notes here just so I don't get anything wrong. But we've chosen to support the Brown Bag Program. The Brown Bag Program is a local organization that primarily supports about 250 primarily disabled adults and elderly that can't care for themselves. And it's a program where we gather non-perishable food items and we package these up, and the Brown Bag Foundation or organization helps deliver them to people that are, again, disabled adults and the elderly that need that kind of help. We chose this organization after looking at a lot, and our belief is, we live in interesting times right now with this COVID still running rampant, and that portion of the population, our elderly disabled adults, there's lots of portions that are being displaced, but we just felt like it was a great organization and the right time for us to help. We sent an email out about a month or 2 weeks ago. What we've done is we've created an Amazon checklist where, from the comfort of your own home, you can go on to Amazon, you can select items that you'd like to purchase and donate, and they'll ship them straight to us here in Scottsdale, and we'll help package that up and get it to the Brown Bag Foundation. If any of you on this call were unaware of that or would like to participate, please email us at info@wildwealth.com. Again, info, don't forget, Wild has an E on the end, wildwealth.com, and we'll get you the information for the Brown Bag Foundation. And that is going to be our focus, our charitable focus for the first quarter of this year. I want to take just a second to give you a little bit of heads up on our educational forum. We had our educational forum for the month of January was Estate Planning Basics, hosted by Jackie Yoder and one of our advisors here in Scottsdale, Ben Zamora. That was posted yesterday. If you missed the event, don't worry, you could email us. We do have it on replay, and I believe we can send that out. So again, if you'd like to see that, let us know. We have 2 more scheduled, one for February, Wednesday, February 24th at 12 p.m. and Thursday, February 25th at 6 p.m. Arizona time. I will be hosting our traditional forecast event. Not to be conflicted with tonight's. I know we said tonight was our 2020 outlook and kind of forecast. Tonight, we're going to let Gene share his thoughts. Next month, we're going to be sharing our thoughts. And really, many of you have attended our traditional forecast event, which we've done for about 15 years. We really focus on how last year ended, some of the economic figures, and then really focus on the numbers, where Gene's going to talk a little bit more about, I think, what we can see as we get onto what we're calling the road to recovery. So again, mark your calendars, February the 24th at 12 p.m., Thursday, February 25th at 6 p.m. These will all be virtual events for the foreseeable future. If you go to our website under the events tab, you can register there, or again, email us at info@wildwealth. And then for that's in February. For March, the topic for March is going to be Roth IRA basics. Michael Obanoff, one of our advisors here in Scottsdale, again, and in Payson is going to be talking about the Roth IRA basics. That is scheduled for Wednesday, March 31st at 12 p.m. and 6 p.m. Again, the registration tab is on our website under events, or you can email us at info@wildwealth.com, and we'll be happy to send you the registration link. So that was just a little bit of business up front that I wanted to get out of the way. But our man of the hour is Gene Goldman. Gene, thank you for joining us again today. As I mentioned, Gene gave us quite a bit of time back in March and April when we were in the middle of the pandemic, and thoughts and outlook. And Gene, I have to say, your words of wisdom were valuable to us as we went through that scary, difficult time. Thanks for being back here with me again tonight.
My pleasure. Thank you, everyone. So let me just spend a few seconds just to share my screen. Just going to share my PowerPoint presentation. Hopefully you can all see that. Well,
Gene,
so
let me interrupt real quick too. Sorry to interrupt you.
Yeah.
So we weren't able to distribute this, but again, for the viewers on the call, a lot of you I noticed, have your video activated. If you're on a listen only, or even if you're on video, if you want to email us after the presentation tonight, we'll get you copies of the slides after the presentation. So Gene, thanks.
No worries. And then what I'll try to do for those of you that don't have the presentation in front of you, I will kind of talk through a lot of points too. So no need to worry about that. But anyways, so Trevor, thank you so much. Good evening, everyone. I'm out here in sunny California. It's cold. To warn you, we're down to about, what is it, like 55 degrees. So it's a little cold out here, but it is what it is. So anyways, just to echo some of the thoughts that Trevor said, I hope you're all very safe and healthy. I think that's most important given where we are right now. Please, as we said this before, just be safe and healthy. These are unprecedented times. So with that said, given how 2020 has been, I've never been so excited in my life to talk about the 2021 market outlook. And just think about last year in the markets and the economy. What a year it was. We had the longest economic expansion in the history of our country end. So the longest, this is over 10 years. It just ended last year, followed by what is going to be the shortest recession on record. So clearly we had this long expansion and then a short recession. And then from a stock market standpoint, as we talked about this when I talked to you guys back in February and March last year, stock market was down about 34% from February 19th to March 23rd. And then it's up about 85% since those March lows. What a huge jump back. So with that in mind, last year when I spoke in front of you, I said, listen, we have our three investment themes. Number one, a U-shaped economic recovery, a little bit conservative than the more aggressive V-shape. So that's the economy going down and slowly coming up. Number two, significant market volatility. And then number three, as we come out of the recession, we'll see a shifting investment landscape where it's not just going to be growth and technology, it's going to be other parts of the market like financials and value, other cool parts. So with that in mind, we do believe all three of these things have panned out. So with this as a backdrop, what I want to do for the next, I think, Trevor, you gave me 5 hours. So for the next 5 hours, just kidding, for the next 4 hours and 59 minutes, what we're going to do is cover, I'm just kidding about that. What we're going to do,
we just had 100 people disconnect there, by the way, just kidding.
No worries. So what I'll do for the next half an hour is talk about our three themes for 2021. So without further ado, here they are. So number one, the economic recovery that we're in right now will be uneven and choppy for the first part of the year. Number two, later in this year, we will find our economic footing and the recovery will eventually broaden. And number three, until we make this transition from part A to part B, we're going to see a lot of choppiness in the market. Stock markets are going to be pretty volatile. I think the last couple of days have really really kind of exemplified this market volatility. But overall, for 2021, we are constructive on the year as a whole. We just really believe the first part of the year in terms of the economy is going to be a little bit choppy. And I'll give you a ton of data beyond these 3 points. So with that said, let's talk about the first one, uneven recovery. And I'm not sure, I apologize, I'm not sure why I have a running theme here, because I think because, I've been at home, I've been gaining a lot of weight, I got to run more, but I guess this is why I threw this in here. But anyways, I'm not sure why I have a running theme here, but please just bear with me. So let's start with the first one. And clearly, the economy has recovered from the lows that we saw last spring. But the problem is that not everyone is recovering at the same pace. And not every person, not every business is recovering at that same exact pace. And there's many reasons we can point to this that suggest why we have this choppy, this uneven recovery. And the three things I kind of want to focus on is number one, the struggling services side of the economy. Number two, the labor market, it's very choppy. And number three, some of the recent economic data that we're starting to see is starting to roll over a little bit. So I'll talk about each of these right now. As we look at this next slide, and I'm not a big fan of showing lots of different economic data slides, but bear with me as we go through a few of these. What this slide shows, this slide plots GDP, the gross domestic product. This is what the entire US economy produces. And you can see it's been moving higher because the economy has grown. On the far right-hand side, and also the gray shading means it's a recession. On the far right-hand side, you can see the sharp decline that we saw last year, and then the sharp bounce back. So what we do believe is that there was a V-shaped bottom. What that means is the economy fell and bounced back fast. But then what we continue to believe is that it's starting to moderate a little bit, start to slow down a little. And I'll talk about reasons behind this. We saw in the first quarter last year and second quarter, we saw GDP drop dramatically. That's a V on the far right-hand side. And then in the third quarter, it jumped about 33%. Today, we saw GDP for the fourth quarter come in plus 4%, a little bit lower than expectations, but again, still a positive number. If you take 2020 as a whole, GDP or economic growth was down about 2.5% versus the prior year. Not that great, but again, remember during the pandemic, it was an ugly, ugly time period. What I think is more important though is when we look at GDP, let's kind of dissect it and let's kind of pull in what the key driver of GDP is. And the key driver is really you and I. It's a consumer. We spend a ton of money, and about 70% of consumer spending drives GDP. So what I want to do in this next slide is really kind of break up consumer spending because it really shows something very, very important. So if you look at this slide, what we've done is we plotted consumer spending on both services and on goods. So services is like haircuts and going to get your nails done. And then goods is like Peloton bikes, buying swimming pools, buying refrigerators, buying TVs. And if you look at this line, these two lines, the purple line is goods spending. This is people buying Peloton bikes and workout equipment. The light blue line is services. This is people not spending as much money in terms of haircuts or other things. What's really interesting is that this recession that we just finished, that we are coming out of, is the first recession on record that's a services-led recession. So what does that really mean from a services-led recession? That really means is that the services of the economy really caused this recession to take place. And there's no big surprise because of the pandemic, the entire lockdowns, the restrictions. Basically, people stopped going to restaurants, stopped going to businesses. Again, this is what's really important. If you look, for example, on the left-hand side, the other gray area, this is the Great Recession. And you can see that services spending is still well above goods spending. And that's a normal recession. In the normal recession, we don't buy cars, we don't buy TVs, we just don't buy stuff because we save our money. And instead, we spend money for haircuts and for the natural services. This recession is the first services-led recession that we've ever seen in our economy. The problem is that because goods spending and buying refrigerators and buying pools and Peloton bikes, going forward, we're not going to buy 5 swimming pools. We're not going to buy 5 Peloton bikes. So this consumer spending cannot keep going at the same pace. This is what really worries us. One little side note, if you look at this slide, just to show you how different this recession is. What this slide shows, it shows home prices. And the gray bars, again, are recessions. And this is the first recession that we've seen of the last 4, where during the recession, home prices actually rose. So you see all the recessions on the 3 on the left-hand side. You can see that home prices have actually declined. On the far right-hand side, the current recession that we're in, you can see home prices have actually increased. Again, it's a very, very different type of recession. But with that said, again, I want to kind of talk about something else. And this recession that we're in, now going back to services, I want to talk about cheddar cheese, okay? And we all know that Trevor and I love to eat cheddar cheese. And if you look at this chart in cheddar cheese, clearly there's one thing that screams out to you. Clearly the drop in cheddar cheese is due to the fact that it's up to no Gouda. So again, cheddar cheese is clearly up to no Gouda. And why do we care about cheddar cheese? Why do we care that there's a sharp drop in cheddar cheese? Well, there's a website called QSR magazine basically. And what they said is that 60% of all restaurant menus have cheddar cheese on their menu. And you can see, given the restrictions on restaurants, given the restrictions in terms of people not going to restaurants as much, there's been a sharp decline in cheddar cheese prices. That's important. And this really shows that restaurants are struggling during all of these dining restrictions. To kind of confirm this, you look at this next slide. This next slide shows open table restaurant reservations. And as you can see on the right-hand side, reservations have started to slow down given these dining restrictions. So again, people are not going as much to restaurants. This is really impacting services. So why do we care so much about this? Well, because 70% of all services jobs, 70% of all jobs related to restaurants, haircutting, nails, all that stuff, 70% of jobs are services related. So until the services side of the economy improves, this is going to overhang our economy for some time. So again, services needs to improve dramatically. Speaking of the labor market, the second reason that we point to this uneven economic recovery is that the labor market is pretty choppy and people are worried about job prospects. So today we did get a really good data point, good and bad. Good is that the numbers came in better than expected. Bad, it's still a really ugly number. So this morning we saw jobless claims, so unemployment claims for new unemployment claims, and they came in up 847,000. That's an ugly number. As I mentioned to you last March, these are not numbers. These are people who are filing first-time unemployment claims. The good news is that the market's expected this to come in over 900,000. The bad news, 847,000 is still a big, ugly number. To put this in perspective, the highest this number has ever been in terms of jobless claims pre-pandemic was 695,000 back in 1982. We are crushing this, unfortunately. But the good news about the labor market is that about half of the 23 million jobs that were lost in March and April last year have returned. That's really good news. But again, this is what overhangs, this is what concerns us near term about the economy, is that there's still about 9 million people unemployed. And if you put this in perspective, during the great financial crisis, the Great Recession of 2008 and 2009, that 9 million people out of jobs today is more than the maximum that we saw back then. We still have a lot of people unemployed. If you look at this slide shows that the number of people who have been unemployed for more than 6 months is now at 37%. So 37% of people have now been unemployed for more than 6 months. So despite the jump in GDP that we saw before, just despite the jump in purchases of goods, this is what worries us. People are cautious about the economy, cautious about their jobs. And this is really affecting consumer spending. So for example, you're seeing personal savings rates are doubling. People are saving more and more money. So this is our second point. Our second point is that this choppy labor market is going to weigh on consumer sentiment. And as we all know, consumer sentiment is very important to the economy. We switch to the next slide. The third reason, which really kind of points to this uneven recovery, is basically recent data is starting to moderate. So you look at this chart, okay, and this chart shows what's called regional manufacturing surveys. So if we take a step back, a lot of times we look at economic data like GDP, or we look at, inflation, and we look at these data points. But the problem is a lot of data points that we look at come in late. They come in about 4 to 6 weeks after quarter end. One thing we like to look at is more current data that's occurring right now. And so what we have here is what's called manufacturing surveys. And these are small regional surveys from areas like Richmond, like New York State, like Dallas. And basically these surveyors, or these people that are being surveyed, are asked questions like, how's business, how's manufacturing, how's pricing, how's supplies, a bunch of qualitative questions. And what the beauty about these reports is it's the first look at the current month month's economy. So the beauty about these is that it's a current look. And if you look at this slide, data for January is starting to come down. This is suggesting that currently January's data is a little bit weaker than people are anticipating. So if you take the weakness in services, if you take the choppy labor market and then you take this weakness in regional data, all this suggests our first theme is that the economy, the recovery is going to be a little bit choppier than people anticipate. So that's the bad news. And, you know, I'm a very optimistic person, so I want to get rid of the bad news right away. And let's kind of go into a little bit more positive. And the positive is just really in the second half of the year, that second half, later in the year is our second theme, that we will find our economic footing and the recovery will eventually broaden. With that said, before I kind of talk about the reasons why we think things are going to get better, let me kind of take a step back and show you something. So if you look at this slide is something that we created. It's called the Social Distancing Recovery Dashboard. So as I mentioned before, when we look at recessions in the past, in the history, or we look at recoveries, you tend to look at data like unemployment rate, GDP, you look at inflation, you look at these this information, but it tends to be a little bit laggard. As I mentioned before, this recession that we're in today is a very different type of recession. It's both a supply and demand shock at the same exact time. So we get a gauge of where we are, not just this month, but really this week. We created this social distancing dashboard. It takes 14 real-time indicators and says, where are we? And these indicators, as you can see here, are like driving mobility, flying, restaurant reservations, unemployment claims. And it takes them, and green is good and red is bad. The good news is that in the last week, 11 out of 14 of these indicators have improved. In the last month, 10 out of 14. So all this dashboard really defines our key message in our second theme, is that the economy is recovering, but we will see more evidence later about this economy recovering. So again, the economy is recovering. We do expect to see it broaden out a little bit later this year. So why do we think this? And there's really three reasons why we think this. Number one, it's the vaccine. Number two, it's stimulus, both fiscal and monetary stimulus, and I'll go over those terms a little bit later. And number three, there's more certainty in Washington. And so let me go through the first one. Let's start with the vaccine. Hold on for 1 second. So if you look at this chart, okay, this chart really kind of talks about vaccine, okay? And again, let's start with the vaccine. And the good news is that clearly people are more confident, and the vaccine is sort of providing that light at the end of the tunnel. It's really going to help the recovery broaden later this year. So just to think about this, to fully vaccinate our population, we need to average about 1 to 2 million vaccinations per day. The problem is that if you look at this chart, this is from a website called ourworldindata.org. You can see this shows you the number of people being vaccinated every single day. Pre-end of the year, so back in December, we were probably vaccinating about 350,000 or so people per day. Today, the good news, especially for the last 8 days, we've vaccinated over 1 million people per day. That's really good news. So all we're saying is that more people are being vaccinated. That's really good news. Again, this helps our thesis about a broadening economic recovery. The second reason why we're positive a little bit later this year is just stimulus, okay? Both monetary and fiscal stimulus. So as we talked about last time, monetary stimulus is basically the Fed, the Federal Reserve, and the Federal Reserve really they have a bunch of these different powers behind the scenes, but one of the biggest power is that they raise and lower interest rates. So if the economy is starting to slow down, they lower interest rates, and basically by lowering interest rates, credit card rates go lower, home equity rates go lower, borrowing costs drop. That's great news. Theoretically, it increases, it accelerates the economy. The economy is going too fast, they raise interest rates, credit card rates go higher. What the Fed done, and if you look at this chart here, especially on the far right-hand side, the Fed came out back on March 15th of last year, and they basically said, sorry, I do apologize. There's some construction going on outside, so I apologize. So again, March 15th of last year, the Fed comes in and they cut interest rates to near zero. The beauty about what the Fed did last March is that they did this on March 15th. This is 6 days from when the recession began, 6 days later. Also, what the Fed did on March 15th or March 16th, they went in and they announced a $700 billion program to go in and buy treasuries and mortgage-backed securities. Without going into the whole topic of what that means, all they're really doing is providing liquidity to the bond market. So again, they cut interest rates and they provided liquidity to the bond market 6 days after the recession began. Think about the Great Recession of 2008. It took the Fed about 9 months before they reacted to what was going on to the economy. 9 months later. So again, they have reacted to this 6 days later versus back in 2008, 2009 was 9 months later. That's amazing. On the fiscal side, so the fiscal side is basically the government coming in and spending money to help stimulate the economy. And if you look at this chart on the top, the purple bars shows personal income month by month. The blue bars shows fiscal stimulus, basically money being given to consumers. And the beauty of what the Fed did, or what Congress did in March and April of last year, you see that sharp drop in income in March and April. This makes sense. The entire economy was shut down. But what the government did is came out and they came in with fiscal stimulus, like $1,200 checks, like additional federal unemployment, basically to help make up the difference. And this is the good news. It's basically the combination of fiscal and monetary stimulus combined together, this unprecedented $12 trillion applied to our economy. So again, this is one of the reasons why we do believe that the economy will broaden later this year as the stimulus works its way through the economy. Now, if we go to the next slide, it's the third positive. So again, as I mentioned before, the first positive is basically, second positive is stimulus. The first one, of course, is the vaccine. The third point is that there's more clarity in Washington. So before I talk about politics, I want to take a step back and just remember, listen, I'm an independent person. I have no horse in the game. I'm not a Republican. I'm not a Democrat. I'm here just to provide facts and information, provide you unbiased information. And so if you look at this chart here, as we all know, the Democrats took both chambers of Congress and presidency. And so we have what's called a blue wave. Again, the blue wave is where the Democrats have both sides of Congress and at the same time, Biden as the presidency. And the good news is the markets have liked this. If you look at this chart here, this chart shows that when there's been a blue wave or a red wave, whenever there's been a wave, historically speaking, the market has done better than a divided government, than a gridlocked government. That's good news. Our opinion is that we don't see it being a wave. We see it more of being a blue ripple. And again, all three parts of, both sides of Congress and the presidency are all Democrat, but we're not saying it's a blue wave. We say it's a blue ripple because there is no significant majority in either part. So why is it such a positive? Why do we think this is a great thing? It's a great thing because this boosts the likelihood of additional coronavirus release. Great news there. But at the same time, it minimizes the chance for higher taxes, for increased regulations. So again, let me give you an example. So when you think about the Senate, for example, the Senate, as we all know, it's 50-50, basically 50 Republicans and 50 Democrats, and Kamala Harris has the deciding vote. So theoretically, the Senate has gone Democrat. If you look at the Democratic senators, the Democratic senators include a relative group of budget-conscious, budget-cautious senators. Key would be Joe Manchin from West Virginia. So Joe Manchin from West Virginia, who's been a very vocal person focused on really not expanding the budget that much. We do believe that you have these budget-conscious Democrats. You still only have a slight majority in the Senate. You have a slight majority in the House. All this means at the end of the day is what the markets are really embracing. Additional stimulus for the economy, which is great news. And secondarily, it's going to be very difficult to pass any significant tax increases or any significant regulatory changes. This is what we like. This is, again, the third positive that's really driving our expectations for an improved economic environment later this year. So again, number one, the vaccine. Number two, we have so much stimulus and more stimulus to come in the economy. And number three, this blue ripple in the government. You've got all three parts of the government all working in the same direction. So if you take all that positive information, let's pivot over towards the stock market. As we all know, the stock market is a very forward-looking vehicle. What the stock market tends to do, it looks at where the economy is headed 6 to 9 months in advance. And this slide shows a bunch of different data. But what the key point here is that for 2021, for this year, the stock market has priced in earnings to rise about 22.6%. It's good news. Again, this is a good news in the sense that the stock market is suggesting the economy is going to get better, and then earnings are going to get better, and then the stock market moves higher. Again, stock market is pricing a very strong earnings growth. So overall for the economy, we are very, very constructive in the economy. All we're saying is that near term, the economy is going to continue to struggle a little bit, especially with the services side of the economy, especially with the labor market. But then later this year, we will see some recovery. We'll see this recovery broaden out. So now the next question probably is, for you is, well, what about the stock market? What do we see the stock market doing during this entire environment? And this ties into our third theme. Our third theme is that market volatility is going to be very high for some time. So let me look at this slide. If you look at this slide plots stock market volatility. As you know, you can look at volatility in many different ways. My team of research people, we're all a bunch of geeks, and we look at like beta and VIX and all these cool little terms. For me, I want to keep stock market volatility simple, and I just basically ask myself, how many days in a year does the stock market move up 1% or move down 1%? And if you look at this, what we've done, we plotted this for the last about 30 years. And you see on average, the stock market moves up or down 1% about 63 times. Last year, this did it 117 times. Stock market volatility is here. And this makes sense because we had so much uncertainty last year about the pandemic, about the economic ramifications. So our perspective is, despite the good news about the economy, despite the good news about the stock market, markets will remain choppy until we get from point A to point B. I think yesterday and today are great examples. Yesterday, we saw the Dow Jones Industrial Average down 630 points. Today, the Dow Jones Industrial Average is up about 299 points. These big market swings are going to be here for some time now. So with that said, in addition to this pivoting from point A into point B in the economy, what else concerns us in terms of likely to raise market volatility? So let me go over a few points. So I apologize, this slide is kind of small and so on, but the thing that we're focusing on, that we're concerned about, is that there is so much optimism in the market right now. Yes, it makes sense that people are optimistic about the economy. That makes total sense because the economy is showing signs of improvement. As I mentioned before, we got some great things to look at, vaccines, stimulus, of course. But if you look at this slide, on the lower part of the slide, there's something called the Investors Investment Survey. It's a sentiment index, and it's a contrarian index. And what it does, it takes the number of bulls and you divide it by the number of bears, okay? The people that are positive versus the people that are negative. And it's a contrarian indicator. So when this line moves higher, it's saying everyone is happy and everyone's bullish. When the line goes down, everyone's worried and scared. Right now, this line is at the highest level since January of 2018. All this is saying is that everyone is so optimistic about the markets and about the economy. That worries us, okay? That worries us because everyone cannot be this optimistic about something going on, okay? That worries us. Second of all, you look at this slide, and I do apologize, this slide has a bunch of different data, but what this slide does, this plots what's called the price-earnings ratio. Price-earnings ratio, as we talked about before, we talked about last year, the PE ratio is the price of the stock market divided by the stock market's earnings. It's a way we look at valuing the stock market. When the line moves higher, the stock market's expensive. When the line goes down, the stock market is relatively cheap. As you see on the far right-hand side, today, the stock market trades at 22 times forward earnings. Don't worry about what that means. All it means is that stocks are trading where they were back at the tech bubble in the late 90s. They're very, very expensive. Yes, we can support this with lower interest rates. We also are optimistic about low inflation in the stock market. But at the end of the day, the stock market with such a high valuation is pricing in absolute perfection. Everything needs to be absolutely perfect. If you look at this next slide, so in addition to looking at valuations, another concern that we have is just, economic surprises. So you think about, let's take a step back and think about the stock market and the economy. So if the economy does better, what happens is that companies produce more widgets, they produce more units of stuff. People buy more, companies earn more money, their earnings growth increases, and basically investors get excited about the stock of those companies. So realistically, a stronger economy equals stronger earnings, equals people buying stocks in the company. And I know I kind of made some not exaggerated, some exceptions, but basically at the end of the day, earnings drive stock prices. But if you look at this slide, okay, and in overall, the stock market loves a positive surprise. They love it when data comes in above expectations, when data beats what's expected. And what we've done here is we plotted this it's called a Citigroup economic surprise index. And what this does, it takes the positives divided by the the beats versus the non-beats. When the line moves higher, the economic data is beating expectations. When the line moves lower, it's coming in below expectations. And as you can see on the far right-hand side, this line has come down lower and lower and lower. All we're saying is that yes, the data is beating expectations, but it's beating it by a less amount. Again, the stock market likes positive, big surprises. And this is something we need to be concerned about. Also, we talked about stimulus. Yes, stimulus is on everyone's mind. But if you look at this chart plots the year-by-year budget deficit, the federal budget deficit. And you look at that big purple line on the far right-hand side. That's the federal budget deficit today, 2020. That's huge. It's gigantic. This is going to weigh on passing stimulus packages within the government. This is Joe Manchin. Again, I mentioned his name again, the Democrat from West Virginia. He is a very budget-conscious Democrat, and he is one of the people that came out last weekend. He, along with Susan from Maine, they basically had a bipartisan pushback in terms of the stimulus package, in terms of the amount of money being earmarked for Susan Collins, being earmarked for stimulus. So again, budget-conscious Democrats and Republicans are going to focus on this number. So this is what we're watching carefully, because this is a potential cause for increasing market volatility. Another concern that could drive market volatility is just rising inflation. Yes, inflation, I'm going to tell you guys, inflation will be higher this year than it was last year. Just from a numbers perspective, last year, inflation was low because oil prices fell, gas prices fell, also services spending fell. But at the end of the day, though, year over year, our inflation is going to be higher, of course. But second of all, we lost a lot of businesses during this pandemic. As we start to reopen the economy, there will be fewer restaurants. There will be a greater demand for those restaurants, a greater demand for goods and services. This is going to potentially cause higher inflation. And one way you can see this inflation moving a little bit higher is this chart here. This chart plots a 10-year Treasury yield. And you can see from basically August until today, the 10-year Treasury yield has gone from about 50, half of 1% to over 1.1%. Pretty quick move. And this is the bond market saying there's potentially inflation coming down the road. Even Dr. Copper here. Dr. Copper, basically, and I always call copper Dr. Copper because it's a great indicator in terms of how the manufacturing economy is doing. Copper, along with other materials, have moved higher dramatically. And this is them pricing in A, demand for metals and materials, but B, just potential higher inflation because commodities are a really good potential hedge for inflation. So here's a little interesting tidbit. We had this index come out 2 weeks ago. It's called the ISM index, and the ISM Institute of Supply Management, it's a manufacturing index, and it's basically a bunch of questions are asked to supply managers. And what we saw in this report that came out 2 weeks ago is that there were price increases in 35 different commodities. 35 different commodities within the index all went higher. The last time we ever saw this happen was back in May of 2011. So again, inflation is picking up. And this is something that could cause markets to be a little bit worried, especially a sharp rise in inflation is not good for the stock market. So I know I kind of went all over the place, and I do apologize. I do apologize for the construction going on here. But listen, 3 themes for 2021. Number 1, the near-term economic recovery will be a little uneven and choppy for some time. Number 2, later this year, we will find our economic footing and we will see the recovery eventually broaden. Again, the vaccine is so important. Again, stimulus, both fiscal and monetary stimulus. Again, just working its way through. And then also the blue ripple in the government will definitely help. The third point is that until we transition from point A to point B, expect to see a lot of market volatility. These big swings in the market are going to continue for some time. So what does this mean? What's the therefore? What's the actionable investment advice for you? Is 2 things. Number 1 is make sure that you are diversified. Make sure you have some of your portfolios invested in different parts of the market. I know you may be inclined to hearing all this news about all these big gains in the stocks, all these big exciting gains. Yeah, those are short-lived. Definitely be diversified. Have a little bit of exposure to different parts of the market, different parts of the stock market and bond market. Diversification is an age-old strategy where you don't have all your eggs in one basket. You're a little bit allocated to different parts of the market. Please Stick with diversification. It offers a smoother potential portfolio ride. The second thing, and this is even more important, things are changing dramatically. Things have changed dramatically. Remember, we ended the longest expansion in the history of our country. We ended the longest bull market in the history of our stock market. Things are changing now. We've got constant information changing, new information, new data. You need, most importantly, to be in contact with your advisor. Be on the phone with them, Zoom calls, meet with them constantly, because again, everything is changing so dramatically. And you need to make sure that they know your situation. They know how much risk you can take in your portfolio. But if you're taking too much risk or too little risk, you need to constantly update them in terms. So this is why Trevor wants you to call him on his cell phone every single night at 10 o'clock to go over your portfolio, all Trevor's advisors. So please, definitely call him constantly. I'm just kidding. But again, yeah. Number one, be diversified. And number two, stay in contact with your advisor, because it's so important right now, because it's a very different environment that we're headed towards. Yeah. So I do apologize. I went all over the place, but again,
no, it's great.
Thank you for taking the time.
No, it was great, Gene. And I really appreciate the way you put this together and kind of hit on the big points. If you don't mind, we've got a couple minutes here, and I've had some of the themes that we're hearing clients talk about, and you hit on a lot of them. But the Federal Reserve has come out multiple times and have talked about their desire to keep interest rates where they are. And this is maybe a segue, because you just talked about the bond market and the reality that eventually we're going to see inflation from a lot of the things that you talked about. Oftentimes, and what we hear from folks in particular, with all of the uncertainty that's been going on from the political environment, really, changing over and what might happen, and then the potential unrest, all the things that you're talking about. And the general thought for people is we need to go to safety, and bonds often get brought up, right? And you touched on bonds and interest rates. Can you just to talk about what that could mean, right? Because what we do know, as inflation comes back and grows, the Federal Reserve's primary tool in fighting inflation is interest rates. What is your guys' thoughts on, do you think, will the Fed be able to retain interest rates where they are now? Do you think that inflationary pressure will come back by the end of this year, or do you think that will be something in 2022 or 2023 that becomes more of an issue?
Sure. Great question. So we do believe inflation will pick up this year, just from a number standpoint, just math, last year, because inflation dropped dramatically, inflation will pick up this year. But with that said, though, we do believe inflation is not going to surge as much as some people are anticipating. You've got a lot of reasons. First of all, the economy, the labor market is still pretty choppy. Right now, the unemployment rate is 6.7, 6.8%. If you look at inflation, and there's an index called CPI, Consumer Price Index, 70% of CPI is related to services inflation. And the number one driver of services inflation is wages. So with nearly 9 million people, unfortunately, unemployed, with unemployment rate at 6.7%, it's going to be very difficult to raise wages. So we don't see inflation jump. We do see higher, but we don't see inflation being extended for a very, very long time. With that said, even Jerome Powell, who's the head of the Federal Reserve, the FOMC, came out yesterday in his speech and said, listen, we will keep rates low for a very long time, because the problem is, once we start to raise rates, it slows the economy down. And the economy is already a little jittery. And Jerome Powell, and I respect him a lot. Jerome Powell, he is pushing so much pressure on Congress to pass some type of stimulus, because in reality, they've done what they can do. Rates, their number one power at the end of the day is to lower interest rates, to make interest rates low. Interest rates are near zero. Yep. They can't really do much any further. So he's pushing to get more stimulus. So again, we do believe inflation will pick up. But again, it's going to be a slow, choppy ride. So we don't see it being extended for a very long time. I saw someone pop a question through, what will the inflation rate be? It's hard to say. If you strip out, you got to strip out food and energy, because they're so volatile. But some people are saying, 1.5% to 2%. The Fed has been trying to get over 2% for a very long time. We still think it's going to take a long time for them to even get close to over 2%. So, yeah, great question. And then, and the other part about bonds, you can see, if you're a bond investor, you are collecting a steady income from a bond, and you want a higher compensation for the increased inflation risk. This is why bond yields have moved higher a little bit. This is why they've jumped, especially since the election. Great question. Thank you, Trevor.
Yeah, I appreciate it. And obviously, the primary discussion are economics, stock market. What about the housing market, right? Like you've showed in some of those slides we've seen. And the majority of the people on this call live in Metro Phoenix, some in Albuquerque, some all over the country. We've seen, really an amazing boom in residential housing values here in the Valley, 20 to 30%. We're seeing multiple listings. Starts to feel a little bit reminiscent of 2007, from a perspective of, is there a bubble building in real estate? How much of that is because of what's happened with interest rates? What's your take on the general housing market?
Sell your house right away. No, I'm just kidding. Just joking.
Move in with Gene.
Just
Move
joking.
in with Gene.
Yeah. Yep. we'll all get bunk beds.
Yeah.
No, listen. It's a great question. So first of all, the housing market has moved higher because of just demographics about people moving, de-urbanization. That's definitely helped. The good news is that going into this pandemic, the housing market was not we weren't in the bubble. Yes, we had pockets of strength throughout the country, especially the East Coast and the West Coast, but we didn't have a huge housing bubble like we saw going into 2007. The other good news is that even if housing prices do pull back, which it's possible, we've had a huge run, and I showed you that slide where housing prices, even if they pull back, I've seen a lot of stats in terms of homeowners' equity. We have a lot more equity built into our homes than we had back in 2007. Part of it is increased regulations around mortgages. Part of it is that we have much lower interest rates right now. So again, the good news is that even if housing prices do come back down a little bit, you have a lot of homeowners' equity already built in. That's a lot different than it was back in 2008, where boom, we saw it fall, and it's really impacted the economy. Plus, there's also increased regulations. So I think we're not cautious. We're just saying, yeah, most of the housing gains have already probably gone through, but at the end of the day, we're not seeing any type of crash in the housing market.
Yeah, and maybe even the consumers being a little bit more responsible today than we saw back in 2006 and 2007. That does make sense.
Exactly.
So the last question I'm going to ask, and we're here at the top of the hour, and I do want to remind all of our viewers and participants on the call tonight, if you would like a copy of the slides, again, you can email us at info@wildwealth, and that's again WILDEWEALTH.com, and we'll get that over to you. Gene made some really great points about communication. As I mentioned at the top of the hour, one of the priorities that we had coming into this year was really having a robust communication and education schedule for all of you to participate in. As I mentioned, we're gonna shift topics from month to month. Sometimes we're going to bring people like Gene on to give us their insights. Some of them are going to be basic topics. Some of them may apply to you, some of them may not. But our intent is to try to make sure that we're helping educate you through this new online forum that we're all becoming more used to. The last question I had for you, Gene, and it's not really relating to 2020, but the events of the day that we're seeing, a lot of media attention around Reddit about the short squeeze that's happening. And again, I think ordinary investors are watching TV and going, geez, how does this really impact me? Can you give us your sense on the general, what is this? Is it a phenomenon? Should we be concerned about it in a larger picture? What's your say?
Yeah, it's a great question. And as a side note, I can't talk about individual stocks, so I can't give you a specific recommendation. So broadly speaking, so what's going on? First of all, Reddit, as you know, it's a message board site. People are going in and they're posting information. I would do, as a side note, I would actually go in there, okay, and check out some of these messages, because they're not like talks about, company X is growing this much business. It is a bunch of like rockets going up. And I actually checked the Reddit video yesterday, and one guy talking about stock, he's sitting there drinking champagne and giving you stock advice. I mean, my God. So, okay, so part of that is part of that, I would just keep that data in mind. But what's going on is that they are, it's not a bad thing. They are finding these stocks that are heavily shorted. So Wall Street some companies are being shorted that they basically mean it's a bet that they'll go lower. And one stock, you know who the stock is. It's a big company, which was a $5 stock last year. It was struggling pre-pandemic because of online competition, because of changing demographics, changing strategy. And this stock was heavily shorted by so many big firms. What's going on is that, when you short a company, you make money if it goes down. If it goes higher, theoretically, you have to buy back the stock at a higher price. This is a self-fulfilling prophecy. Secondarily, these same traders are also buying these options, these options to buy a stock at a higher price way higher. And now these companies that write these options are saying, oh my God, this company is going way higher. I need to go in and buy the stock to hedge myself if it goes even higher. This is becoming a self-fulfilling prophecy. What you're seeing, the ramifications from this are these big companies that own these, that are showing these companies need to get cash to buy back the shares. So they're selling out of other parts of the market. This is why we saw the sell-off yesterday in the stock market. Part of it was basically selling the good stuff to buy the bad stuff. Is this bad for the market? I do think it is, because there's a little bit less regulation. If you go on there, you can just type in whatever you want. You can be Mean Gene and type in a little comment, and people are listening to it. This worries us. This is why you're seeing some key people come out and say this needs to be more regulated. I do worry about the long-term ramifications, because this is a potential bubble. It is a bubble. And you know, in a bubble, someone is going to lose. Someone will definitely lose money. And what worries me, this is very similar to 1999, where we saw people were buying stocks based on price per clicks. You know, how many clicks are you getting? What's the price per click? You have to watch out for these things. So again, you know, a lot of the investments that Trevor and all the other advisors put you in are diversified. Yes, you might have a little exposure to these companies, but you're not putting all your money in. Look at that one stock, I'm not going to say its name, but you know the poster child of this whole thing went up like 100%, went down like 50%. Again, you got to be careful, because a stock, you have to, for you to make money, someone else has to buy it at a higher price. There comes a point that it's not going to happen. And it's like Tulip, you know, there's the whole book, Tulip Mania. Read about Tulip Mania. It's the same thing. You need someone to buy it from you. And I'd be a little leery about this. So, but the good news about all this is that it shows that other parts of the area needs to be regulated, and it's really opened eyes to regulate. I think that's good, because the more regulations you can have to improve, to help all investors, I think is the best thing. So.
Yeah, I appreciate that. A couple of quick comments here, and then we'll wrap it up here. We're at the top of the hour. And I think one of those was geared at Eugene. I don't know if the person who asked the question knew that you're living in California, but a lot of people believe that there is going to, and we have seen some migration from some people from California and our neighboring states into Arizona. I don't know if you're seeing that in your neighborhood or not. And then last question here, someone without stock to have buy volume says there will be some without stock value. We'll have to buy the stock. The volume is way over outstanding share value. I think just talking about the bubble that could exist. And to your point, what we typically experience is, you know, the person who really gets hurt is the person who gets in last. That tends to be the retail investor. You know, one of the things, and now I'm speaking to everybody else on the call. One of the things that we focus on, we have a weekly investment committee. Our committee meeting was this morning, and what we're focusing on is fundamentally what are the risk reward measures that we're looking at. Right? We try to keep this non-emotional, but it is an emotional world. And so as you're going about your daily life, as you're watching TV, dealing with your family, we do want to be a resource for you. I want to thank Gene for being on here tonight with me and on previous calls. I didn't give his normal introduction, but you know, Gene gets a lot of demands to be on CNBC and a lot of places. So Gene, thank you for spending some time with us this afternoon and running through your outlook for the year. And I want to remind thank you. And I want to remind everybody, you got a little guy behind you. I want to remind everybody else on the call. Yeah. We are here for you. Keep an eye out on our communication schedule. We've got conference calls and educational forums that are going to be scheduled as we get through this year. If you have questions that we weren't able to cover tonight, please email us or call your advisor on our team. We'd love to talk through it with you. And again, I want to wish everybody a safe evening. Be safe, be healthy, and we look forward to seeing you all very soon. So thank you again for your attention tonight. And thanks again, Gene.
Thank you.
Thanks, everybody. That's the conclusion of our call. Bye now.
Bye.